All right, welcome to the latest edition of the InvestTalk Wealth Webinar, coming from our brand new office
Look
here
at
in
this
Irvine,
wall.
California. So excited to create some more content here, and this is actually the first time we're doing it. So we're pretty excited and pretty excited to share this presentation with you. A lot of interesting ways to uh, solve a lot of problems that many of you have. So we're going to dig into that. Obviously, Luke and I will be your presenters, and this is our agenda for the day. We'll talk about, this is going to be a relatively short presentation. We will do a Q&A session about half hour in. So, this will be shorter than most of our wealth webinars because we do get a lot of feedback from our listeners that they want more Q&A. So we're going to get to that as well. But I'll go over market update. Luke will do a deeper dive into custom indexing, what it means, what problems it can solve, et cetera, and then we'll dig into our strategies and then that Q&A. I'll start off with the market overview. So, first off, we had that break, Liberation Day, and markets have been weakening overall, and credit markets are the main driver here. And what you can see is this is a ratio between short-term junk and short-term treasuries. And when this rolls over, this is a couple days old, but it's actually today it weakened a bit more. And what you can see, it's in a downtrend. That means credit spreads are widening out, and it's something that will continue to, if this continues to deteriorate, the broader equity markets will deteriorate. And the longer this sits on the tariffs sit there, creating economic damage, we will definitely have a downturn continue in markets. And this is why we're definitely watching the credit markets and whether this stays in a downtrend or not. So far, it certainly has. Uh, we're also looking at where money is flowing. So you have international equities starting to outperform for the first time. So this is a ratio of international stocks, so EFA, to the Russell 3000, which is a very broad-based U.S. index. And so for many years, you've seen this in decline, meaning money was continuing to flow to U.S. markets, mainly driven by the Mag 7, AI, et cetera, and also a stronger dollar. So typically, when the dollar is strong, the international investments actually underperform, and vice versa. And what you're seeing now is the dollar rolling over and money now flowing out of U.S. markets and into those foreign markets. And for many years, you definitely saw those foreign investors chasing the double whammy of a stronger U.S. economy and a stronger dollar. So they were getting benefits in both directions. Now you're actually seeing the opposite, and that's why money continues to flow overseas. So that's one way that you can generate alpha, generate better returns in your portfolio is follow where those money flows are going, and it's definitely going overseas. Now, the volatility index, another area we're watching. The higher the volatility, the worse the market is generally going to be. Okay, so what you can see is this has been an uptrend really since the beginning of the year. It spiked up, and usually it's correct when you get a spike that is a good time to buy equities in the short term. But when volatility is generally higher, say 20 or above on the VIX, that's when you get kind of downtrends in markets. You can see back in the summer of last year, you had the yen carry trade unwind, and you had volatility spike up for a short period of time, but it soon settled back into the mid-teens. And that is a nice level of volatility that tends to correlate with uptrends in markets. So where we're watching this as well is, will volatility stay elevated? Is it going to stay in the low 20s or higher? If it does, that generally is going to mean a downtrend in markets. And then I wanted to highlight this because when trends shift, you usually get reversion to the mean. And so this is a good encapsulation of various research companies that are looking at the various asset classes, from equities to foreign markets to bonds, et cetera. And they all have different opinions. They're not No one's going to be right in all of this, right? They have different models, but the equity models definitely use a combination of current dividend yields, valuations, and earning growth expectations to see what the expected returns are going forward over the next 7 to 10 years. And what you can see is that equities generally are, U.S. equities especially, are generally likely to underperform those foreign markets. And if you look on the bond side, they typically use current yield. So, if rates are up, that tends to be what the yield, the prevailing yield you buy bonds at tends to be the yield you get over the long term. Why? Because defaults tend to be pretty minimal. So I wanted to highlight this because there's definitely some shifts in what you should probably expect in returns for asset classes going forward. Now, GMO is another one. This is one Jeremy Grantham is a value investor. Now, he's always kind of underweighted the U.S. markets because of this, because of valuation. So this is probably not going to be 100% accurate, but you can see the stark difference between, U.S. equities versus foreign value, for example, and what should be expected in returns going forward. So, there are various factors that will tell you whether this will hit its mark or not. But one aspect of this chart is that, it depends on where rates are. If rates are lower, are real rates lower, or real rates higher? Market minus inflation, if that is positive, that tends to be a drag on asset prices, on the economy, et cetera. If you have more neutral or negative real rates, that tends to be more inflationary, it means to correlate with higher economic growth, and you tend to get better asset returns. So a lot will depend on what that looks like and Fed policy, and that's one of the reasons why the market tends to follow the Fed. And then there's liquidity flows. So whether liquidity is abundant or not, that's going to be a huge factor in whether asset prices generally perform well. In 2022 is a perfect example. You had the Fed going out there, seeing too much inflation. They pulled liquidity out of the system. And what happened to asset prices? You had a big drop, 33% drop in the NASDAQ, 20% drop in equities. Bitcoin dropped from 64,000 down to 16,000 or something like that, which tends to be related with that is a huge factor as well. So, you don't take these as gospel, these projections, but more of a guideline of kind of generally based on current valuations, growth expectations, what areas of the market are likely to perform over the long term. So that's kind of my really quick presentation. We'll have more Q&A in a little bit on current market conditions, so we can talk a lot about that. But next, I want to turn it over to Luke so he can really unpack custom indexing and how it can fit into your current strategy.
Thank you, Justin, and thank you, Daniel, for the comments on the stash as I just came up. That's why I'm laughing and smiling. Been working really hard on this over the past couple months, so I appreciate that. But the reason why we wanted to talk about custom indexing today broadly is because we're very excited to be able to offer to our clients and our potential clients a...
Turn mic on.
You guys hear me?
Okay, keep going. So we're very excited to be launching this new offering to our clients and to our potential clients. And so the question is, what is custom indexing? And custom indexing is a new product that we're launching that allows you to take generally accepted benchmarks, indices, whatever you want, say the Russell 3000, the S&P 500, a value index, and impart your taste and preferences on that index. And so maybe you don't want to own tobacco names, or you don't want to own coal names, or any sorts of names that you don't want to own because you get stock options from those companies, or anything. We can, in a diversified and tax-efficient way, mimic the returns of indices, keeping into consideration tracking error, while also tax loss harvesting along the way. And the reason why this is possible is because of our partnership with Orion, through our data integrations, through all the tech-enabled data we're able to achieve now, that we can look on a daily, weekly, monthly, quarterly, annual basis to find those securities that operate in a similar way. And so within any of these strategies, let's say you're mimicking the Russell 3000, we can accomplish that return with far fewer names, giving us optionality in what we want to harvest, when we want to harvest, while still keeping at pace with those returns. And so the reason why I'm mentioning this is because in general, investment is about iteration and improvement, right? And so back in the day, when you wanted to have an asset class delivered for you, you would invest in mutual funds. Mutual funds were great collective investment vehicles, but they tended to be pretty tax inefficient. Not only were they tax inefficient, they could also be pretty costly. You'd have application fees, you'd have redemption fees. A lot of those costs would be hidden in trading. And then along came ETFs, and ETFs made the mutual fund structure far more tax efficient. you would only bear the tax burden of your applications and redemptions within these funds. And so what custom indexing or direct indexing can do is improve upon that as well. So let's take this example. If you, in your brokerage account, hold the S&P 500 as an ETF, you hold SPY, you're getting the benefit of the return of that fund. But what you're not getting by not holding those individual names is the benefit of understanding that over time, not every name is going to be positive in any given year. And so here's an example of various years, I think going back about 6, 7 years, and it shows you the return of the index, how many of those securities were positive performers, but also how many were negative performers. And so by understanding how correlations work with various companies, we can sell those underperformers, we can tax loss harvest over time, we can build up those tax assets for our clients, while also keeping pace with the returns of what you are trying to track. And this is just showing how that benefits you over time. This is what we call tax alpha. And so you all know, as investors, the benefits of compounding. And so if you are generating 1% tax alpha in 1 year, that compounds over time. And so over time, that could add up to as much as 11 years into retirement of extra retirement assets. One other benefit that it has for our clients is the ability to diversify those concentrated investments. If you were fortunate enough to get stock options, stock from the company in which you work, and you want to track the Russell 3000, US market-wide exposure, we want to take into consideration what those holdings are and not buy those companies that give you similar exposure to Microsoft, for example. So as we're selling out of that concentrated position over time, as we're offsetting it with those losses that we're taking, along the way, we're iterating the portfolio to maintain that consistent exposure while being tax efficient. This also works for if you're selling a business or if you're selling real estate. If you know down the road that you want to sell the business that you've had for decades, that you want to sell that property, that you no longer want to be a landlord, well, then we can do this in advance. We can take this portfolio and we can create those tax assets to offset those gains over time, again, making it more tax efficient down the road when you need to sell out of those assets. And lastly, one customization aspect is prioritizing your values. If you buy the S&P 500, if you buy the Russell 3000, if you buy any of these commercially available ETFs, you're stuck with them. By using our custom indexing strategies, what we can do is at the start create this portfolio without holding any of those names that you don't want to hold for value reasons, religious reasons, or just because you don't want to be exposed to the company that you already have exposure to. Going to bring Justin back on to talk a little bit about our portfolio review process, and then we'll dive into what our offerings are. Again, we can customize it to whatever you want, but what our pre-canned offerings are, and then dive into some Q&A as well.
All right, I'll make this quick so we can get to the Q&A, but I want to, oh, there we go, a little bit too far. Just highlight, kind of what we do with these portfolio reviews. First off, they're free. We do them for clients almost every day and many every week. And it's a video conference with me or Luke, or you can come in to our office here in Irvine if you're local. And we review clients' goals and concerns. Everyone has their own idiosyncrasies of what they're looking to achieve. Luke just talked about what custom indexing can do. That's just one aspect, right? There are other types of strategies that we deploy, which we can go over on a portfolio review. Things like covered calls, individual bonds, et cetera. All these things we can really unpack. And really, it's really about understanding your current portfolio. So this is a good example of what you're weighting in all the different sectors, what's your duration risk for the bonds that you're holding, what's the credit risk that you're holding, what about the risk that you're taking with your assets. And so we really dig into the details and give you a comprehensive report on that. And then, see what strategies make sense. We have our traditional strategies that you probably have seen on our website. These are some of our strategies that we've created on the custom indexing side, where first global, foreign, as well as domestic exposure. Second would be just if you just want U.S. exposure. Then you have dividend focused. And then you also have, something that's smaller mid if you want kind of longer term growth potential and the most upside. And willing to have that volatility. But this is just the start. As Luke said, you can customize these in almost any way possible. So don't look at these as like the only way to achieve custom indexing. It's truly custom. You can, like Luke said, if you're a pacifist and you don't want to invest in anything that has to do with the military, you can do it that way. If you don't want tobacco companies, you can do it that way. If there's one company that made you mad back in the day and you don't want exposure to that particular company, you can exclude that company as well. So it's extremely, extremely customizable. And so I wanted to really highlight those capabilities. And then if you want to get in touch, obviously go to our website, click portfolio review, or email us or give us a call. And there's a new address if you ever want to stop by and speak with us in person. Now we're going to launch a quick poll so we can kind of understand from you guys what maybe hit home for you in this presentation. And we'll be back on in about 1 minute, and Luke and I will go through a Q&A session. So we're back on, and it looks like the number one topic that really hit home here was diversifying concentrated positions.
That's what I thought it would be as well.
Really?
I thought it would be as well. Yeah, I think a lot of people are benefiting from getting compensation as stock options, right? Or maybe they have a brokerage account and they're particularly fond of Berkshire Hathaway, which if they were over the past year, it's a pretty good decision to have been. And because of that, they want to take that into consideration with professional investment management. I think that's a really great aspect of custom indexing because it's not just about the position itself, right? It's about how positions interact in a portfolio and how positions interact related to each other, their correlations. And so it's not just about not buying Microsoft, it's about buying other companies that don't perform like Microsoft.
Yeah, we see this a lot where, if say it's a Mag 7 company, you work for a Mag 7 company, and your position in that company is going to be highly correlated with the broad tech industry. So the index that we create, custom index, can reduce the other holdings within tech so that your tech weighting is not very high, and then slowly diversify that over time based on different goals. So what do you think number 2 was in those 4?
Selling real estate?
It was actually number 3. Number 3. Number 2 was actually aligning investments with personal values. So a lot of people, maybe they don't like a certain leader of a company, a certain subsector.
You like Coke, but not Pepsi?
There you go. Could be it. Yeah, maybe that could be it. Now, let's see. On a scale of 1 to 10, how confident are you in current strategy based on underlying economic environment? Most people were at the best answer was a 7.
7. That was the highest.
The highest stats, 24%.
Okay.
But only 4% had a 9 and 2% had a 10. So that means a lot of people are unsure. So this is what we do with our portfolio views, is kind of make sure those portfolios are aligned with the current investment and economic backdrop. And number 3 is, which custom index strategy best fits your investment style?
I would guess global.
Global is number 1, 39%. US core 25. Dividend focused is 30. So that's second. And then you have US core at 25, and then small and mid at 14. So that was an interesting poll, and we can obviously dig into this a little bit more. But we'll pivot over to let's stop sharing that. And let's pivot over to our Q&A. So don't hesitate to put any questions in to the chat. Where's the chat? I have the chat somewhere. There we go. There's the chat. All right. Yeah, don't hesitate to put in any questions. So one was, how did your clients fare during the last few weeks of craziness? Is something that we want to be able to make it through while still increasing our investments. Well, I'll say we definitely have outperformed the broader markets. A lot of our strategies had elevated cash levels. We had overweight in kind of non-cyclical sectors as well. So that certainly helped. What else do you think helped us weather the storm well?
Yeah, well, I think flexibility in general, right? So most investors are invested in ETFs and passive. It's quasi-passive investment in terms of how it trades, right? And so in times where there's high volatility, you tend to want to have the opposite. If you're invested in the S&P 500 as 50% of your allocation, that fund is not going to raise cash because its job is not to raise cash. Its job is to track exactly how the S&P 500 does. And so in times of high volatility, that's where you can see the benefits of more active management, where you can be more tactical, raise cash allocations like we did. And that really shows itself in terms of comparative return in times of uncertainty.
Yeah, yeah, and this is a year-to-date heat map of the S&P 500, and as you said, Luke, they're just trying to match the overall index, and the bigger the box here, the bigger the weighting, and what you can see is a lot of actually green year-to-date in the smaller boxes, but a lot of red in the bigger boxes, and so when you're able to create an index that just doesn't just hug the S&P, you can start to create alpha there and reduce risk. Um, Clay's asking about fees. So taxes offset the fees. Do they offset the fees? Now, a lot will depend on what tax bracket you're in.
Yeah.
Right. If you're in the highest tax bracket and you're saving on taxes, you have other capital gains that you're offsetting. The fees do typically make sense. So the fees on the custom indexing side for us are 25 basis points quarterly, so 0.25% per quarter. So just a heads up on there. Joanne said, I'm in the cover call strategy. I think I heard the dividends from ETFs are taxed at a lower rate. How are accumulated dividends taxed when I withdraw funds from my account?
From his equity income account?
I think for any account is what she's saying. If it's a taxable account, money coming out isn't a taxable event. If it's an IRA, it is a taxable event, right? So it kind of depends on what you're talking about there. It says, did you move funds on your own, or did your clients have to reach out and ask for change? No, we moved on our own. So when our clients allow us to manage their assets, we have control over trading. That's pretty much it. And so we keep our clients abreast of the situation on our weekly newsletter. We do a monthly update for our clients. So they're very in the know of kind of what we're thinking. But yeah, office hours. Yeah, we have office hours today, actually, usually at 1 o'clock. We're not doing it this Wednesday because we're doing this, but typically every Wednesday at 1 o'clock, we're doing office hours as well. Let's see what else. Warren wants to know about Japanese companies. Are we looking at any Japanese companies? I would say yes. We
We're
are.
always looking.
We're always looking.
Right?
We do have a couple on our watch list.
And I think that, like Justin said when we were talking about the market update, the current prevailing dynamics are such that you can start to see benefits of investing internationally that you haven't seen over the past 15 years, right? The U.S. exceptionalism trade, which has made U.S. markets rise substantially higher as growth has been higher, inflation has been lower than it has been globally, starts to look like it's unwinding a bit, and most of investment return is essentially where cash is flowing, right? And foreign investor cash that is frankly on the sideline in the US right now is flowing to markets that haven't beaten the US in some time, like Japan, like some European markets. And so aside from getting the potential excess returns, that additional diversification as well is beneficial, I think, to portfolios.
Definitely. Thomas is asking, how do you handle customer accounts? Does the customer keep their IRA or brokerage account and you work with it, or is the account turned over to you? Great question, because this should be the same answer should always be for every advisor, which is clients keep their accounts the way it is. Our clients custody at Schwab, it's an IRA in their name, it's a taxable account in their name, it might be a trust, it might be a joint account with husband and wife, whatever it is, the account is held in their name. We just have the authority to trade those accounts. That is it. So that's how Bernie Madoff stole the money.
Yeah.
It's because they handed the money over he was the custodian, and when you're the custodian, you can pretty much do whatever you want. Obviously, Schwab, Fidelity, et cetera, they have the regulators that they work with to make sure money isn't stolen. So that's why you always want a third-party custodian, not the advisor holding on to the money. Let's see, what else do we want to get to? James says, I appreciate the notion of general exposure to all sectors, but in the current climate, is it advisable to be overweight in oil, energy, gold names, forfeit exposure to consumer cyclicals, defensive, retail, et cetera? Is this strategy appropriate for an aggressive portfolio focused on capital appreciation? I have at least 20 years before retirement.
That's a long time.
Yeah.
So you have plenty of time before retirement. I go back to the point of think of where we are now. Think of where volatility is now. Think of where the dollar is now. Think of where flows are going now. 4 months ago, did you think that was going to be the case? And the answer to that is yes, if you made a lot of money right now. But for most people is no, which means that dealing with having zero exposure to various sectors means that you can be offsides on events pretty quickly, especially as they change pretty quickly. And so when we're constructing portfolios, we like to think of tolerance bands over which we're going to be overweight or underweight so that you don't find yourself drastically offsides when things rapidly change. Now, specifically for oil, right? Oil prices are pretty low right now. It may be signaling some sort of demand contraction as they typically do. But does that mean you don't have no oil exposure? If you have a 20-year investment horizon and you can hold on to some really, really cheap oil names for a couple of years, you have a lot of benefits there from names that traditionally, when economic activity picks up again, you benefit really, really well. You held on during oil names in the pandemic and came out of it. Those are some of the best performers in 2023.
Yeah.
And
that's why when we look at, we send out our quarterly update for our current clients as well as our listeners. So if you're part of our email system, you get that. And we have overweight and underweight different sectors. And that's why we don't have particular targets, because there's, for everybody, it's they might have different core weightings of different sectors, and based on the economic backdrop, you do want to be overweight or underweight. But to forfeit, as Luke said, the entire exposure altogether is probably not a good idea. Because, as Luke said, you might be offsides, but also, there are opportunities in every sector at any given time. Right, there are good companies to own. It might be only a handful versus maybe in other times, but you never want to just shun a whole sector altogether.
The other thing I want to say too is that, and I was incorrect. Oil did well in 21 and 22, not 23, but you missed, I think, about 80% of the recovery if you weren't invested in the market for 6 weeks after the great financial crisis in 2008. And so that just goes to show how quickly things can turn, and how you always want to be careful about how much exposure you're giving up based on what you currently think is happening relative to what could happen in the future.
John is asking, what is a good strategy to avoid paying too many taxes on a typical IRA when you're required to take out 4%? So let's talk about RMDs. So this is, for example, something we didn't really talk about on this webinar, but it's part of what we do for clients. So it's not just the investment side, which we talk about investments. This is InvestTalk, et cetera. But it's the planning side. So it's looking at what your life is today, your financial plan, what the your income and expenses are, your assets and liabilities, and then also modeling that out, going out 5, 10, 20 years, and doing things like Roth conversion strategy. So that's what this really hits on, which is typically between retirement and taking Social Security, or retirement and taking those RMDs at 73, 74, 75, whenever you're required to do that. You do conversions, you convert at a low tax rate, and you're able to reduce, or sometimes for some people eliminate RMDs entirely and lock in a low tax rate on that money. Because remember, anytime you have an IRA, a 401k, and it's a write-off in the particular year, that's great, but that's creating what is called a deferred tax liability in the future. And having an advisor like us, that we do, is to help you manage through that through your life. So, when we talk about our fees, and somebody asks, what's our fee for accounts? Our average client pays about 30 basis points quarterly, so about 1.2% per year. Some are a little lower, some are a little higher. Depends on total assets they have with us. But it's not just about the investments. It's also about that constant communication, access to talk about. I talk to at least 1 or 2 clients almost every single day to go over their situation. And then there's also the planning side, where we really look at everything beyond the investments as well, and try to plan out so that the different goals, maybe that's sending a kid to college, maybe that's retiring early, maybe that's buying another house, whatever it is, it can be earmarked and planned for, and we can have the proper investment strategy for those particular goals. So that's part of the planning side, which is the Roth conversion strategy.
It's also important to understand too on the fee side as well, right? Is if an advisor is charging you 1%, but they're putting you in all ETFs, you're also getting fees layered on that you're not even seeing. So the fee that we have at agreement signing is all you're going to pay, all you're ever going to pay.
Yep. So, but we buy. That's what the custom indexing does as well. We're not buying an index. We're looking at an index, and we're trying to mirror the return of that index, but we're using individual positions in that index. And so that is how that works. And for all of our strategies, and remember, this custom indexing strategy, this is for taxable accounts. This is not for your IRA. It's not for your 401k. This is for taxable accounts. You're talking about a trust account. You're talking about, like I said, an individual brokerage account or a joint account, something that is taxable money. Okay. So I want to ask, what is your percentage you gain over the year in your investments as a whole? So, that's something we talk about on the portfolio reviews. One thing potential clients often do is, and this is average investor in general, they chase returns. Okay, what did well over the past year, and I want to be in that, right? That's not how our process works. Our process is, what risk tolerance level should you have? What are your goals, and what type of risk should you take to achieve that particular goal? And so that when times are rough, like now, it's our job to try to limit any losses and kind of tread water. But it's more about, are you in a point where, okay, you see volatility, you see the Dow down 1,000 points, does that freak you out or not? Does that create emotions for you? And if it does, then you probably shouldn't be in that type of strategy, because you are going to sell at the wrong time, right? When everyone else is despondent. 2022 is a good example. Market was in a big downtrend. I started seeing very, very bad sentiment, especially from our listeners, people that I talk to. And it was one indicator, along with many, along with liquidity inflecting positively, that we should go very strongly into equities and hold very little cash. And so, there will be a time like that again, but it's up to the advisor to make sure that our clients are not jumping out at the wrong time, both by coaching them through this process, as well as having the appropriate investment strategy. So, we can talk about those if you ever do a portfolio review, but it's less to do with, okay, what happened over the past year and what the strategy and risk you should be taking in order to achieve your particular goals. John says 50% of portfolio in cash, bonds, and Roth, 401k, individual, using your crystal ball. When should I invest? Timing is always very difficult, but you can also see trends that are emerging in markets. We talked a little bit before about money flowing overseas, starting to outperform in foreign markets. The dollar starting a downtrend. All those have different. It creates a backdrop where different sectors outperform and underperform. Luke said this best, and to give him full credit for this, and I love this, which is that in times like this, all that happens is the opportunity set narrows. There are always opportunities in markets. In bull markets, we can put a newspaper up behind us and throw some darts, and we're probably going to do fairly well because almost everything's going up, right? In times like this, a lot is going down, but there's still a subset of names that are trending higher, that are benefiting from the current economic environment, the current uncertainty. Gold is one example, right? But there are others within the various sectors that are benefiting as well, and money is flowing into. So, I would never say, oh, this is the perfect time. Obviously, having good liquidity is helpful, but it's really about finding, and that's what we do for our clients, finding those opportunity sets that still exist in any market.
It also very much depends on your time horizon, right? If you're trying to retire in the next 2 years and you can't really stomach volatility, you don't know when you're going to be needing the money to drawing it down, it makes more sense to shift towards more bonds, right? Because you're trying to preserve capital for when you're trying to send it. So the answer to that question is as often tends to be, it's very person specific.
Yeah. This is a question about bullet shares and a bond ladder, building a bond ladder for conservative retirement age customers within their 401k, IRA, Roth IRA. So what he's speaking about is bullet shares. So let me pull this up. Let me pull up one of them. Bullet shares, I believe. Am I spelling bullet right? Bullet shares. There we go. Let's go bullet shares. So these are, I'll just pull up one. Here's corporate bond 2033. And what you're getting here are a bunch of corporate bonds that mature in 2033. So you're getting diversity along with targeting a particular duration risk, right? Now, there's nothing wrong with that. I have no issue with that. We do something similar. We're buying individual names. We're finding the best within, kind of that maturity schedule and laddering those out. You can do it yourself using this. We find our strategy better once again because we can find better risk versus reward. This you're getting that broad diversification, but I have no issue with it if you want to do it yourself.
Well, you also get par value back at maturity, right?
Yeah.
When you're buying the individual bonds versus investing in these ETFs as well.
Yeah.
And so you do have the potential for losses if rates turn dramatically.
Defaults.
Because the whole point of bulleting and laddering and where that becomes a really good strategy is liability matching, right? If you know that you're paying tuition quarterly for your kid's college, and so you want to match the cash flows to those liabilities that you have, well, if you have it in ETFs and bullet ETFs, you stand to potentially have some downside there because you're not getting those bonds back at maturity. So that's kind of one of the benefits as well as doing it on an individual bond basis.
Yeah, and you look here, and this is the 2033, and we use a lot of corporate bonds, so we're very familiar with kind of the prevailing rates in the corporate bond market. But the yields of maturity on this portfolio is only 5.1%, and you have a credit rating about triple B plus, which is very similar to where we operate. And so there can be some defaults because that does happen, but your yield is only 5.1%, whereas for our clients we're getting closer to 6.25%, 6.5%. So you're definitely giving up some return potential for that with that diversity. So I think it's fine. It's something you want to create yourself, but there's definitely more upside to doing it through individual bonds. Clay says, can you say more about selling real estate relates to new customized index investing?
Yeah, so when you sell real estate, you have to pay taxes on your gains. And so similar in the way that we are helping our clients using deferred sales trusts to not have to pay taxes up front when they're selling that real estate. In a similar way, you can lower your tax liability with custom indexing by banking those losses over time. If you recall, right, we showed you that chart, and that heat map is proof in the pudding of what's going on here in terms of you can look at an index and not everything is positive or negative together, right? There is a lot of diversity there. And so the benefit, if we're constructing, let's say, a Russell 3000 index for you, is you only have to own 200-300 names. And so if, for example, Exxon is down and you can take some losses in Exxon, and let's say it has a really high correlation to Chevron, which it may or may not. These are just examples. Well, then you can sell that Exxon and still maintain that exposure that you need by buying that Chevron and holding that for 30 days so that you don't violate the wash sale rule. And so over time, like that chart was showing, for 5 years before that business was being sold or that real estate was being sold, you start to bank those tax losses over time that can help offset those gains down the road.
There you go. That's a perfect example of what this strategy can do for those taxable accounts. And one question is, what are your offerings relative to estate planning? Now, we do offer our clients to build a will and trust through trust and will. So that's something that we do. But this fits perfectly for trust accounts, which are taxable accounts. So this is a good way to tax manage a lot of that money that is in your estate. How do you charge your managing accounts? You want to tackle that one?
Yeah, so for the accounts we manage, well, obviously we manage a whole lot of different accounts. We manage our 401k accounts for clients. Those we don't bill and charge directly. We set up a separate cash reserve account that we keep invested in interest-bearing securities, usually SGov or money market fund. And so for those types of accounts, we'll bill directly from that account. For the accounts that aren't 401k accounts for which we have trading authority, what we will do is on a quarterly basis, whatever your quarterly fee is, we will deduct directly from that account by either selling overweight securities or some of the cash that we have on hand. But the most important part is it's fully transparent. We send you a quarterly statement. You can check on what we're doing on a daily basis via Orion or through Schwab. So it's all fully visible.
Another question is, when you talk about deteriorating U.S. exceptionalism, how long of a time horizon do you keep and focus on international assets? Is it a long-term generational play or a few years? My answer is simply, we don't know. You have to continue to watch the trends and see if the trends persist or the trends waning. Right now, this current trend is relatively new, but it is persisting. And I think that is what's most important here. And I can actually bring up, I'll bring up this chart and I'll dig into a more daily chart. So this is the EFA to IWV. So this is Europe. So there's a broad foreign market, developed market index. If this is going up, it means that's outperforming the US domestic market. Now, this kind of broke out even before Liberation Day, before Trump took office, and it correlates also with the rollover in the dollar. And so that's a big factor here is the dollar continuing to weaken. And if it is, then money tends to flow overseas, and you also tend to get more economic growth overseas as well. So this is something that, like I said, is continuing to persist. That could change. You want to be flexible. I'm a huge fan of strong opinions, loosely held. And if the data tells us that this trend is no longer persisting, then you shift back. But this is certainly a trend that we feel based on valuations, obviously the loss of a bit of trust in the U.S. System, that money is flowing overseas, and we're seeing that in the back end fund flow data as well. What are the minimum amounts for custom indexes? So that is going to be 500,000 or more. 500,000 is our minimum on that. If it's, we're a bit flexible on that number, but that's kind of the baseline there. Adrian asks, do you work with Canadian investors? Fortunately, we do not. There's a rule.
It's not because we don't like them.
Yeah.
It's because they won't let us.
Yeah, they won't let us. Canadian government does not allow us to work with Canadian citizens. Ryan says, can you talk a little bit about how you trade these custom indexes through your partnership with Orion? Do you bulk import on Excel sheets with your target allocation for each stock, or do they have a specific function?
We do not bulk upload on Excel sheets, and the reason why is because that would be incredibly cumbersome and inefficient, right? So it's the data infrastructure that Orion has allows us to soak in a whole bunch of data, which is easily visible and abundant these days, and look on a daily basis at changing correlations. Because the whole job, right, and we obviously focused on tax efficiency here, but as with anything, the primary purpose is return. And it's not to beat any particular index, it's to match that index's return over a given period of time to a tracking error of about 50 basis points to 1%. The secondary priority is the tax loss harvesting part, right? And so we can set tolerance bands on how much you want to tax loss harvest, but the primary focus, again, is tracking that index. And so if you're trying to do that over time with far fewer securities that exist within that index, then you have to use a process called stratified sampling. And so you look at correlations of securities, you put them in correlation buckets, and you try and maintain those weightings similar to how the index is done. And as I'm explaining this, it sounds very complicated, which means you really can't just do it on an Excel sheet over time. So that data infrastructure with our partnership with Orion is really what allows us to understand these correlations and how they change and manage those portfolios.
Yeah, that's why it's very dynamic and difficult to execute if you don't have the right data. But luckily, as Luke said, with our partnership with Orion, we get that data updated regularly, and it allows us to keep those correlations as tight as possible. So with that said, I think we're going to close up shop. Thank you for attending this wealth webinar, our first one from our new office here in Irvine, California. And hopefully you'll be seeing some more content coming out of this office as well in the near future on our YouTube channel, as well as our podcast. So thanks for tuning in, and we'll talk to you again next time.